Good morning. Marc Ostwald from ADM Investor Services International with some thoughts on the central bank activity that we've had this week and the market activity. I'm going to start off with the activity in the S&P 500 futures. Two charts. The first one is to highlight the point that after the big slam dunk that we had a couple of weeks ago, we do seem to be getting a lot of volatility. But on the other hand, while we are volatile, we do seem to be very pinned to the 200-day moving average, which on that chart is the 3052 red line that we've got there. And I think that indicates a certain degree of ambivalence in the market about which way they should be jumping, having had the sell-off and taken some of the extreme overvaluation out of the market. The next chart is the same sort of thing, but just to indicate roughly where the range trade is at the current point in time. Obviously, there's a big gap above at some point, which will probably have to be filled, but those sort of gaps sometimes actually take years to be filled. So S&P 500. Moving on. Let's compare that with the US 10-year Treasury yield. Now, by comparison, that has been a straight line down. I think the instructive part, given that this is a 10-year chart, is just how sharp this move has been by comparison with the Euro crisis. So that's that big sharp fall back in 2011. And with other moves down, we're down at 0.77. I think the key point here for everyone to take on board, really, is that at some point we actually have to acknowledge that there's going to be some sort of correction. And that may actually be the most damaging aspect for all financial markets, be that credit or equity, if we start to have a little bit of a correction here, because chasing 10-year yields down here, even if there is flight to safety flow, is not exactly the world's most sensible trade, given the rally that we've already had. It's not to say it can't go lower. It's just to say that chasing it down at these levels, particularly where we've come from since the beginning of 2019. So my fourth chart is a very simple one, just to emphasize just how much volatility we have in financial markets at the moment. That's the Move Treasury Volatility Index and the VIX index. As we can see, particularly over relative to last year, we're still at extraordinarily elevated levels, and we are likely to remain so given the chop that we've seen both in the equity index futures and indeed in US Treasuries. I should sort of emphasize at this point, I'm just using the US because it is the most deep and liquid market that we have. So finally, my final table here is about world interest rate expectations. We had the 50 basis point cut from the Federal Reserve and from the Bank of Canada. We've had 25 basis points in Australia. I think the important thing in Australia and Canada is it's not less than 3-4 weeks ago that both central banks were saying that the balance of risks in terms of returns, the risk-return reward, was that they didn't want to fuel any further push in their house prices, particularly given the high levels of household debt in both countries relative to income. They're about 180% in both. It leaves the question, though, is this the right solution? It's not to say that they shouldn't try and mitigate the effects of that we're going to have on demand from supply shock, but surely it would be far more effective to introduce measures such as tax credits, targeted support for the economy from governments, rather than encouraging the most high-risk sectors to borrow more and increasingly support zombie-type companies. And I think that's going to be the challenge as we go forward, because rolling back tax cuts is far more easy than rolling back interest rate cuts, as we've seen over the past 10 years. And those are the thoughts for this week.